In this video, I will walk you through the ProForma tab of the MSA Analyzer. This is probably the one tab you will spend a majority of your time when it comes to underwriting a multifamily property. This is where you will be implementing your business strategy, looking at the historical data, coming up with your zero analysis, coming up with your ProForma analysis, if there's any taxes, your insurance. All of that would take place on this tab. There are several different sections that make up this ProForma tab. So first, I will start by going through a high-level summary of these different sections, and then I will run through a sample underwriting, just putting in some numbers, and you can see how I approach this ProForma tab. The first section, when you first come into the ProForma tab, is that same summary banner that we saw in the unit mix section, which shows you the name of the property, the number of units, the year it was built, the waterfall that's displaying these returns based on the type of waterfall selected in your summary tab. If I select a pref waterfall, those are the returns, internal rate of return, cash on cash, that will be displayed here. Also shows me some detail about my current analysis. So this changes as my ProForma changes. Right now it's showing 0 because I don't have any data in terms of like my year 0 analysis or my future ProForma analysis. The purchase price based on that purchase price on the summary tab, the sales price based on our cap rates and exit year NOI, the going in market cap rate, the exit market cap rate. So this same banner will show up and in all the different tabs, including all these output tabs. Going down the ProForma tab, the next section is your historical analysis. This historical data is the T12 data, the annualized data that we analyzed back in the T12 video. So it pulls the data from this annualized table, which has the T1 all the way to the T12 analysis. And on this historical data table, you can look at the property through different periods. If I wanted to look at the property on a T12 basis, I can select T12 income from the drop-down menu, select T12 expenses from the drop-down menu. If I wanted to look at this property on a T6 T12 basis, I can look at on a T6 T12 basis. If I wanted to look at it on a T3 T12 basis, I can also do that. If I wanted to look at it on a T6 I can look at it on a T6 basis. That way you can compare the historical performance of the property to see how it's currently performing through different periods. And when we underwrite deals, we like to look at operating expenses on a T12 basis and the income on a T12, T1, and T3 basis, just to see how that income is trending over time. Within the historical table, you also get some information about the property. So this is a property cap rate based on the asking price. So this takes the NOI. So if we're looking at the time period in terms of the historical analysis on the T3 T12 basis, it takes the NOI over that period, that annualized period, based on the current asking price. So the asking price for this property is 40 million. So based on that NOI and that asking price, it tells us that the property cap rate 6.0. Assuming that the market cap rate, this is not correct because we just put in a random number in there at the beginning. Assuming that the market cap rate was 5 and the property cap rate was 6 based on the in-place financials, that looks like a good deal because you're buying this property at a higher cap than when the market currently thinks the property is worth. The next part of this, right below the property cap rate estimation, you have this is the direct cap property valuation just based on those historicals NOI. So we have the option to kind of change. If we wanted to see what this property is worth based on the market cap of 5%, we can just change that, and then you can see the valuation based on the T3 T12, T1 T12, and T12 T12. Say I want to look at a range. Let's do 6. We can see what that valuation is at a cap rate of 5 and the valuation of cap rate of 6 all the way to the valuation of cap rate of 7. Again, this is just behind the napkin type analysis. when it comes to determining the purchase price for these properties, you have to do a comprehensive discount cash flow analysis. The second part of the ProForma tab is our year zero analysis. So this is where we normalize the income and expense line items to year zero. If you were underwriting your deal as of today, these are the numbers that you're underwriting based on. So this is based on the current rent roll. This data comes directly from the unit mix, and there's a note here that tells you where that data is coming from. So that's from the unit mix, that's the unit mix. So if we go into the unit mix tab and we look at that metrics table, we can see that the loss to lease is 6.44 and the vacancy is around 5. If we go back into our ProForma tab, we can see the loss to lease is 6.44 and the vacancy is 5. So we're saying that as of today, as of year zero, once you take over that property, the loss to lease is around 6.5 and your vacancy is around 5. Again, this is not the end of year one. This is as of today, taking over that property. And then we have the concessions and bad debt non-revenue for a year zero analysis. That tends to mimic, like, say, a T1 or a T3 based on the time period in which you're doing your analysis. You would just enter that information on there. So that applies to all the other income as well as the expenses. And we'll run through a scenario in a few minutes. The next section is more like your ProForma or your future projections. So after looking at doing some market research, speaking to your property manager, getting some CoStar data or real page data, you can do your projections for the organic market rent. This is the market rent growth. So this is organically, like, what does the market reward you for just owning that multifamily property? So this is the organic other income growth. And then you have your loss to lease, vacancy, renovation downtime. This will be pulled directly from the renovation tab, concessions, bad debt, non-revenue. So you can model each of those economic losses from year one all the way through your whole period. Currently, the loss to lease is around 6.5%, and you spoke to your property manager. For example, he said you can bring that down to, say, 4% by the end of year one. You can reduce that to 4%. By year two, if your property manager says you can bring that to 2%, then you can reduce that to 2%. So this is how this works. These are your future projections based on your market analysis, data from CoStar, RealPage, or Yarda Matrix. And that applies to all of the economic losses. The only exception is the renovation downtime, and this is pulled directly from your renovation tab based on your renovation strategy and plan. The next section in your ProForma analysis section is your other income. If you have any ongoing RUBS, as we can see from this property, based on the T12 or T3 T12, they're currently collecting about 114% of the water and sewer expense. So this is 100%. Probably want to discuss with your property manager if that's something that's feasible from day one. If it's not feasible, then on your zero analysis, you probably want to normalize that at 100% instead of 114%. But you can make those adjustments in your other income analysis, and we'll walk through the process in a few minutes. So we have the expense growth. This applies to all the expenses within this operating expense category, except insurance and property growth and property management fee. Those three categories have a different growth because insurance has been rising faster than other expenses, and property taxes tend to vary from one county to another in terms of like the growth. But these expenses will apply to all the other line items within expenses except insurance, property tax growth, property management fee. This drop down button, this asks for a water retrofit savings program. There are some properties that you may go into and realize that they're spending a significant amount on their water expenses, and through your discussion or your business plan, you may want to implement a water retrofit program. If that's the case, if you select yes from this drop down menu, then you can model a water retrofit program where you can, based on the current expenses, you can model how much you plan on saving per year and how much you'll be getting reimbursed each year based on that expenses. And one thing to note is if you select yes from this drop down menu, as in you want to use this water retrofit program, the analyzer automatically turns off the water RUBS from your other income section And this information, it's what's used in your ProForma analysis. If we go into the monthly operating statement, that information will now come from this retrofit program. If you're not doing a retrofit program and you're just working with the existing RUBS that they have at the property, then you want to turn this off, because once that's turned off, you can see the retrofit table becomes grayed out, and now the analysis is being pulled from this ProForma line. The next section of your ProForma analysis is your tax estimation. One of the cool things about the MSA Analyzer that will save you a lot of time is that you can preliminary estimate what the taxes are for that county. If you know the taxes that were paid the previous year, or you know the millage rate as well as the tax reassessment cycle for the county in which you are looking at a property in. If you want to just grow the existing taxes by a certain percentage, this tax growth percentage, you can just leave the estimate ProForma property tax to no, and it will tell you to please update the total taxes below line 58 with projected taxes. This is reminding you to do is that you have opted to not use this tax estimation tool, but instead to manually put in the taxes. If you do not overwrite the information on here, it takes the taxes from the most recent historical analysis, in this case the T3, T12, it takes those taxes and grows it by this growth percentage for property taxes. So in this case, it takes the taxes of 416,000, which is the taxes on the T12 analysis, and it grows it by 3% in year 1, 3% in year 2, and so on, based on the predefined tax growth percentage. If you do want to use MSA Tax Estimator tool, then select yes from the drop down menu, and it's going to ask you a series of questions. The first is the appraised value. What percentage is this property going to be appraised at? For most counties, it ranges from like 75 to 100%. If you're unfamiliar, I usually just set this to 100, just saying that whatever the last transaction was or whatever they're trying to sell that property at, that's where it will be appraised at. If you have the taxes from the previous year, you can enter the amount that was paid, saying the taxes from 2023, we're currently in 2024. You can enter the taxes that were paid in 2023, the estimated fair market value or the taxable amount. That information will be available on the taxes, and using those two numbers, the analyzer calculates what's called an effective rate. And for most counties, the effective rate tends to mimic what's the millage rate, and the millage rate is what's used to estimate your taxes. So there are two ways to use this estimator to come up with preliminary tax estimate. It's either using the millage rate. So if you have the millage rate, you don't have to input this information. It's either using the millage rate, which you can select and put in your millage rate, the year the property was last reassessed, the next reassessment, the percent assessed at the next reassessment, and analyze your taxes using the millage rate. If you do not know the millage rate, but you just have the taxes from the previous year, you can enter the tax amount that was paid last year. So in this case, $416,000. The taxable amount, that information is available on the tax bill, the year it was last assessed, the next reassessment cycle, because based on what you select here, if you have a county that taxes are assessed every 4 years and the taxes were last reassessed last year and the next reassessment, let's say it's in year 3, if you select year 3, what the analyzer does, it's going to continue to grow the existing taxes based on this growth rate, and in year 3 it's going to do a new reassessment based on the new value of that property the last time it was transacted to come up with the new taxes. If it's a county that the taxes are assessed every year, I'll set that to 1, then put in my percent assessed. This varies from one county to the next, so you just have to make sure you get that information from your the tax assessor's office. So if you call the tax assessor's office for that county, you should be able to get that information. Sometimes you can estimate it based on the information on the taxes. If you take the tax amount or the taxable amount on the previous year's taxes and divide it by what that property was valued at, it will give you the assessed percentage. And because we're using the effective rate in this scenario, I will select effective rate. And by selecting effective rate, this estimator tool will use the data provided, so that's the taxes paid and the taxable amount, as well as the percent assessed, and this effective rate to estimate what my taxes will be for year one. And embedded in this section is also a link which is embedded in the tax assessment information cell. If you click on this link or click on that cell, it pulls up the publicrecords.netraonline.com. This is a useful resource if you're trying to find the taxes for a particular county. If I'm trying to find the taxes for, say, a property in Georgia, I would select Georgia. Let's look at a property in DeKalb County. Oh, there it goes. I'll go over to DeKalb County and click on DeKalb, the city of Decatur taxes. This will come up and I can search for taxes for that property. It varies from county to county. You can go through the entire process. It would ask for like the property name or the address or the entity that holds that property, and you can search and get the tax bill for that property. So this is a useful link. It's already embedded in this title, so you can use that to find the taxes from the previous year. And to the right, property tax information, you can put in the parcel number, the county name of where the property is located, the city where the property is located, and the reassessment cycle. So that's just addition. None of this information is used in this estimator table. So this is more general information about that property and where it's located. Right below the tax estimator is this below the line capital reserves. When it comes to capital reserves, there are two ways to model it. You can either model the capital reserves in your ProForma as part of the expenses, or you can model the capital reserves as below the NOI line. If you model it as part of the expenses, then it comes above the NOI line. If you want to model it below the NOI, then you want to set this below the line, which is below the NOI line, capital reserves, to yes. If this is set to yes, this table becomes active. And if we go into our operating reserves, the capital reserves is now being analyzed based on the below the line CapEx, and the cap reserves here will be set to 0. If it's above the line, that will come above the NOI line, which is this line. If it's below the line, then the capital reserves will come below the line here in the capital reserves. If we go back into our ProForma tab and set this to no, and we go into a monthly operating statement, we can see now that below the line returns null or 0, and it's analyzing the data based on whatever information we put above the line in our expense line item here. The last two tables are just something to help you with. These are the rule of thumb table for your expenses, so you can work with your property manager to update this table for the city, county, or state in which you're analyzing properties. That way you have an idea the cost per unit for the different expense line items. So when you're analyzing a deal, you can quickly go through that analysis without reaching out back and forth with your property manager to figure out what are the estimated taxes for this line item or that expense, but you already have a general idea to do your preliminary analysis. The same applies to other income. You can model an other income here to see the amount that you'll be able to receive based on the cost as well as the income that you could receive for that particular other income item you're looking to implement at the property. Now we've gone through all the different sections of the ProForma tab. Let's quickly run through a scenario. Let's say this was a property I was analyzing, how I will approach this. A lot of these is just going to be a bunch of assumptions that I'll come up with right now. But if I was analyzing this deal, I'll have to do my market research, pull up my CoStar report to make sure that my projections are in line. But what I like to look for, I look at the historical data on the T12, T12, T1, T12, and the T3, T12. From here, using my most recent rent roll, I can see what my gross potential income is, and I like to compare it to the historical data, and I can see it appears the market rent, if we are assuming that these market rents are correct and up to date, By this time, I would have done my research to make sure that my gross potential income is it's in line with the market and my current time period. The loss to lease based on the most recent rental is 6.44. You can leave it at 6.4. I like to just round it up to 6.5. The current vacancy is 5 based on the most recent rent roll, so I'll keep that as 5. And this note here is also just to help guide you, to tell you where that information is coming from. Because once you upload your T12 and your rent roll data, this information will default, will preloaded. You can update it, but it will default based on the information under unit mix tab. The concessions, I look at the historical concessions. I can see on the T3, it's about 0.9. On the T12 is about 0.5. That kind of trended up to about 1.3. So I can round this up to 1. My bad debt is around 4.9 on the T3, a little bit higher on the T12. So I'll set my bad debt to 5. The last economy vacancy is concessions is around 0.5. So I'll set that to 0.5. And keep in mind, as you update the information here, you can see that in your year 1 pro forma is also being updated, and you can make changes here. Initially, this was defaulting to the 6.5, but we changed it earlier when I was going through the different sections, so that's why it's 4. But if you go through a new MSA template, it will default initially to whatever information you have here. The water and sewer rubs, if we look at the rubs for the T12, we can see they collecting at about 124%, which seems high. Usually you want to cap that at 100% for most counties. We like to underwrite assuming we'll be able to collect about 90% of the rubs, just based on what the county allows and the county that we underwrite this property in. So for this, I would normalize it to 90%, because even though they may be collecting 114% or 120%, once you take over the property, in order to run that properly effectively without cutting corners, you need to kind of follow the county laws and the county regulations, and they may just limit to 100%. For now, I'll set that to 90%, and that's 90% of the water expense. Right now, we don't have any water expense, so that's why that's defaulting to 0. Gas and electric, for the common areas, it looks like they're about 5.3% on the T12. You can either use the T3, T12. I like to look at the T12 for utilities, because that's more seasonal. So I want to look it through all the different seasons and see what the expense was and what they're able to collect during that period. So I'll set this to 5.3. Cable internet, there's no reimbursement for cable. They're not collecting anything for cable, so I'll set that to 0. Trash reimbursement, they're collecting about $29 on the T3, T12. On the T12 about $28, so I'll set this to $29. Parking, currently no collection for parking, set that to 0. Pest control is at $3. This is $3 per unit per month. Again, this is my year 0 analysis. This is how it is as of now, without any pro forma or future projections. Storage currently set to 0, not collecting. Washer and dryer, it's very minimum. I'll leave that 0 for now, and I'll get more information from the broker. Other income, $48 on the T3, T12, $37. So somewhere in the range of like 35 to 45. T1, probably wouldn't use the T1 because you may have an outlier. You can always go back to the T12 analysis to kind of see if you have any outliers in your data. For the sake of this quick analysis and quick overview, I would just assume about $48. So we'll just go to T3. So that wraps up the year 0 income section. And for the year 0 expenses, this is based on your rule of thumb table. So this is based on your market knowledge and how your property manager would operate that property, not necessarily from the historicals. You can use the historicals as a guide, but you want to underwrite based on how your new management company will be running that property. So quickly going through this, for a property of this type in our market, I would say this is 300 units, it's about 350. Marketing is about 200. Cable, they're not collecting any cable. Contract services about 200. Gas and electric. Utilities for the most part tends to remain the same. You can implement a water retrofit program if you spending a lot on water bill, but you probably want to get more information how the meters for the tenant, if they're individually metered or how that is set up. So for gas and electric and water and sewer, I'll just keep it as is until I get more information. So I can just keep this as 157, or I can just round it up to 158 to account for any decimal places. Landscape, they're currently at 123. This tends to remain the same because they usually have a contract in place. You can always change this once you get more information. So I'll set this to 124. Legal, I like to underwrite legal at 100. And for most properties, the admin would include both your admin costs, your general admin costs, as well as legal. So combining this with our admin is around 450, which is where they're currently operating this property at. Make ready, it's around 350. Payroll, I can go with 1500 based on what they're currently charging. Repair and maintenance cost, that seems a little bit high. I would do 400 here, and I would just do clarify. Any line item that you want to get more information in. The reason I'm trying to clarify is because on the historical, it seems a little bit higher than what I would underwrite. So I just want to gain more information from my property manager if this is being too conservative, or should I increase that repair and maintenance expense. Trash, most lenders tends to look at the historical trash expense. So this seems a bit high. I would underwrite anything from 200 to 250. But in the meantime, if we plan on getting a loan on this property, the lender would want to know how we plan on reducing the trash. For now, just keep it as is for 345, rounding up to 346 to account for any decimal places. And I can always make adjustments. So I can follow up with my property manager, see if I can bring that down. The last line item in the variable expenses is our utilities. Like I mentioned, utilities tend to stay the same, so I'll keep it at 270, increase by $1 to account for decimal places. And as you can see, as we are updating the expense line items, anything that had a reimbursable item, such as the water and sewer and the gas and electric, that data is automatically updated. Insurance has been going up for a lot of properties that we're paying $557, but for a property like this today, it's probably going to cost us around $1,100 for insurance. And I can just make a comment that need insurance quote, just to follow up with our insurance broker. Property management fee, they're currently paying their property manager $115,000. For this, I think we can get away with 2.75%. It's 300 units. Which seems in line with what they're currently paying. The taxes for year 0, we can keep it as is. When estimating taxes, the monthly operating statement, the analysis will be done using these tax table, which we'll look at in a few minutes. Capital reserves, I like to set that at 250. And we can see by normalizing our income and expenses using data on how our property manager would operate his property, our expense ratio is around 47.5, which is a bit higher than what they have in their historicals. And our property cap based on the asking price is around 5.92 compared to the 6.0 on the T3, T12 analysis. The next step is your ProForma or your future projections. And this is based on your analysis, looking at the market, looking at your CoStar reports to see what the projections are, speaking to your property manager. Let's assume you did an analysis on the market and you can see that rents are projected to grow in the first year. And this is the organic rent growth by 4%. And in subsequent years, it's going to come down to 3%. So you underwrite year 1 rent growth by 4% and year 2, 3%, all the way to your whole period, which in this case is 5 years. Other income, you can leave it as 3%, or you can use the data you find from CoStar. Let's say the other income mimics the rent growth, so we keep it at 4% and then 3% thereafter. The loss to lease, we already made adjustments to this. We went in at year 0 at 6.5. We're saying that by the end of year 1, we'll be at 4%. and the end of year 2 will kind of stabilize it at 2%. The current vacancy is 5%, but looking at this property, 1999 property, this is a B plus, depending on if we're doing a value add. At this time, it's like a B minus. I would say I would probably look at the historical vacancy at the property and the market. If the historical vacancy has been trending somewhere around 7%, then I'll increase this to 7%. So just because a property has a 5% vacancy doesn't mean you keep it at 5% vacancy. You want to look at the historical vacancy, because vacancy can vary based on the season. If the historical vacancy for that market or the property is around 7%, then I will increase that from 5% to 7% in my ProForma analysis. Concessions, I feel comfortable leaving that at 1%. Bad debt seems a little bit high. Let's hope with new management we can bring that bad debt down from 5% in year 0. The end of year 1 we should be at 3%. By the end of year 2, let's be conservative, we'll bring it down to 2%, and by year 3 we bring that down to 1%. Non-revenue 0.5% seems fine. For our total economy vacancy, we're underwriting to stabilize at around 11.5%. That seems okay. For a class B property, I'd like for it to be around like 12%. So maybe I can even, let's see, maybe let's keep, that's fine. I'll leave it at 11.5%. The water reimbursable items. So if this table, it estimates the percent of the other income at stabilization. As is right now, we're saying that all these different line items we underwrote in our other income, they're already at stabilization. But what if we took over this property and the T12, the water reimbursement, what if this was only at 50%? But we know in this market that we can get this to 90%. To underwrite that, what you would do is come to this section where it says projected other income, because this 40,000 is assuming you only collecting 50% of the water expense. But you know, based on your market knowledge, that you can increase this to 90%. This projected stabilized amount is what you will be able to collect at stabilization. It defaults to whatever you have in your year 0 analysis. But if your year 0 analysis is only at 50%, that's not stabilization. Stabilization, we know we can get up to 90%. So I will come in my projected stabilized other income. So this is column Q. And here I can say at stabilization, I think this property will be at a 90% of the water expense. So I'll be able to collect about 90% of whatever I'm paying in water and sewer. And if I change that, I can see this is the amount that I can collect at stabilization, but this is what I'm currently collecting, only 40,000. But at stabilization, I should be able to collect about 73,000. So if you compare the 40,000 to the 73,000, the analyzer is telling you based on your year 0 collection, that year 0 is only 56% of what you should be collecting or you should be able to collect at stabilization. So this 56% is saying that 40,650 is only 56% of what you should be able to collect at stabilization, which is 73,170. And if you see in your year 0, year 1, 2, 3, all the way to year 11, now it now shows 56%. In this percent other income at stabilization, you can slowly grow this percent at stabilization until you hit 100%. So you can say with a good property manager, by the end of year 1, maybe you take this 56% to about 70%. With good management, by the end of year 2, you take that 70% to about 85%. And by year 3, you hit stabilization at 100%. Now it's saying that going in at year 0, you were only at 56% of the potential income you could have collected from water and sewer based on how much you were spending. But as part of your ProForma, you can grow that over time until you hit stabilization at 100%. Gas and electric, we can see that they're not collecting much. because the tenants probably have that individually metered, so they're paying gas and electric directly. So we just leave that as is based on whatever they're paying for the common areas. So it's already at stabilization. This amount, which is what they're currently paying their year 0, based on the T12 is already at stabilization, so no changes there. The same applies to the trash reimbursement. But what if we spoke to our property manager? We looked at all the different properties in that area, and we can see that they actually charging about $50 in trash. That's an exaggerated amount. But right now we're only charging $29 per unit per month. But what if we can go to $50? How do you model that? I will come in my projected stabilized other income. So that's the amount that I think I should be able to collect once this property has been stabilized. I would say I want to be able to collect $50 times, so that's per month, times 12. So that's $50 times 12 times the number of units. So the number of units is 300. You can either type the number of units 300, or the analyzer have built-in labels for the number of units. I can just type number and you would see the number of units come up. Select number of units. So that's $50 times 12 times number of units times whatever percentage you think you'll be able to collect. Are you going to be able to collect 100% from all the tenants at stabilization? Probably not. So I will underwrite assuming I'm able to collect just 90% of that stabilized amount. So 0.90. And if we look at our data now, this is just a warning telling you that the formula at the top and the formula at the bottom are different from this formula, because we manually overrode whatever formula was in there. You can just click the drop down and hit ignore error. Now, if we look at this trash example, or this T-Rubs example, we can see in our year 0 analysis, they're currently collecting $29, which is based on the historical data, but we're underwriting assuming that we can take that $29 to $50 at stabilization per month. And that is only based on our current collection. We're only at 64% of our intended stabilized amount. So now this defaults to 64%. And now we have to model how we think we'll be able to hit stabilization, or how many years it will take for us to hit stabilization. We can say by the end of year 1, we can get up to 75% of the stabilized amount. By the end of year 2, we can get to 85% of the stabilized amount. And by the end of year 3, we can get to 100% of the stabilized amount. And one thing to keep in mind is, as you adjust this percent stabilized amount, if we go into a monthly operating statement, that amount is also being adjusted here. So you're going from your year 1 through to your year 2. A better place to see that represented is in your annual operating statement, where if we look at the trash expense, we can see in year 1, we're going to be at $121,000, in year 2, $137,700, and in year 3, we're going to hit stabilization, that stabilized amount, and that's going to remain stabilized until the end of our whole period, which is that $50 per unit per month, assuming we're collecting 90%. So you can use this table to play and implement new other income line items. For example, if there was a few parking spots you wanted to add, you would just follow the same process to add parking into your other income. Expense growth, we'll model this based on inflation. Currently it's about 3%, so we'll keep it at 3%. If you know market where expenses have been growing faster than 3%, then maybe you put 4% there. Insurance has been growing faster than other expenses, so maybe for insurance, once I get my quote for the first year, maybe I'll leave the first year 0, because I already received a first year quote. I know how much I'll be spending, but for the subsequent years, I'm going to underwrite assuming insurance is going to increase by, say, 5% per year. Tax expenses, we can keep that at 3%, or based on the feedback from our tax consultant, we can change that to 2%. Because taxes is more of like a higher value item. Property management fee, that defaults to whatever we set into the year zero analysis. If you work out some kind of agreement with your property manager where your property management fee goes down over time, you can make the adjustment here, or you can just leave it as is. Water sewer retrofit program, we're just going to use the current water and sewer, but if you want to implement one, then we'll turn this to yes. And once we set this to yes, in this other income section becomes grayed out, and the operating statement now pulls the data from this table. For this analysis, we'll set this to no. Estimate pro forma taxes. If we have the tax bill from the previous year, we can put all of that information here to estimate our taxes. For this overview, I'll just set the taxes estimated to no, so we can just use the previous year's taxes and grow it by 2% over year. And now the taxes will be pulled from this table. And with that goes through all the different sections you will need to update in your pro forma analysis. The only thing that hasn't been updated yet is number of unit renovation downtime, but that would come after we update the renovation tab. So please check out the renovation video to see how this economy loss line item would look like once we model in our renovation plan. And with that completes the pro forma analysis, or how to use the pro forma tab. And with every other tab, all the data, our pro forma analysis, this information will flow into our monthly operating statement. This is more of an output tab where the analyzer will perform a comprehensive month-over-month analysis based on the year zero analysis, the pro forma projections, our taxes, our insurance bill. It will perform a month-over-month analysis, a comprehensive month-over-month analysis over the income and the expenses. For more information, please check out the video on the monthly operating statement where we go through the different sections of the monthly operating statement. That wraps up the video on the ProForma tab of the MSA Analyzer. If you have any questions, please reach out to us by visiting our website at www.msanalytica.com.